Hi, Chris Pegg, Director of Wealth Planning at Brown Wealth Management. We wanted to take a minute to put out some information about a new law in California that is probably not getting enough attention for many of our clients and can provide a really large tax savings. And it's something that we want our clients to be aware of and make sure that to the extent there's questions, you're contacting us and contacting, most importantly, your tax advisors to ensure that we can take the most advantage of it. And to be very clear, who this is for, this tax benefit would be for those people who own what are called pass-through entities. So limited partnerships, S corporations, any of those kind of business entities where all of the taxable income flows directly through to the owner rather than paying a tax inside of the entity itself. And so we're going to talk a little bit about that. And the advantage relates to the limitation around SALT deductions that changed in the past. So let's just jump into it. I'm going to try not to take too much time, but I want to make sure we hit on what we can. I also want to point out that, if I can make the screen move, I also want to point out that a lot of this is unclear. We have not gotten much feedback from the FTB, except for the law itself. There aren't regulations yet. We do expect to hear some things. So please recognize that you need to look into this, and we need to work, again, calling us as we start to get more information and then working with your advisors. And we need to start now for some reasons that I'll talk about. Okay, here's what the advantage is. Essentially, it allows for a full deduction of state and local taxes related to pass-through entities. It's indirect, but it gets around this $10,000 deduction limitation that we got from the Tax Cuts and Jobs Act. Again, it's for those owners of pass-through entities. There are some restrictions we'll talk about, but it's for those owners of limited partnerships and S corporations. And we have lots of clients in that situation. It doesn't have to be an operating business necessarily. We have lots of clients who are real estate investors through those pass-through entities. Lots of clients doing a number of things, utilizing pass-through entities, and this could be available for many of them. So it really could be important. And the savings is pretty substantial. I'll run through some numbers in a little bit, but the savings could be in excess of 3% of your overall tax bill. So if you really think about those numbers, again, we'll go through some, it can be really impactful. So what is it? What's happening? Well, as you recall, the Tax Cuts and Jobs Act under the Trump administration said that rather than allow for a full deduction of all the state and local taxes that are paid, they limited that deduction to $10,000 per year per taxpayer. And so essentially within California, all of us hit $10,000 immediately, and we lost the deduction for everything above and beyond that. Assembly Bill 150 that was signed into law in July by the governor allows an indirect deduction for state and local taxes by electing to have the partnership or the S corporation pay the taxes for the owners. And I'm going to talk a little bit more about what that really means. But what's more important is it looks like the IRS has essentially approved this deduction. They in a statement said that, I've got it, I think we've got it there. So notice 2020-75, that they're going to be promulgating regulations which will allow for these, what they define as specified income tax payments, to be deductible by the partnership of the S corporation when we're looking at K1ing out the income to owners. All right, how does it work? So we all understand, to the extent you own a partnership or an S corporation, we'll understand that the S corporation and the partnership do not pay taxes themselves. Essentially, whatever money is made there then gets bundled and K1'd out to the individual owners. And those individual owners are responsible for paying federal income taxes as well as California income taxes. But because we lose the deduction above $10,000, all of those California taxes that we're paying don't affect the federal tax bill that we're paying. And so what this law allows is for the entity itself, the S corporation, the limited partnership, to elect to pay a tax. There's something you never thought you'd do, especially here in California, is elect to pay a tax. But it is what happens. The partnership elects to pay a 9.3% tax to the FTB, thereby reducing the amount that gets K1'd out to the owners. And now when the owners get the K1, instead of paying a California tax, they get a credit for what the partnership already paid. But the advantage is, of course, and again, we'll go through numbers in a second, what comes out, K1'd out to the partner that is taxable on a federal level is less, right? It's reduced by the 9.3 that we already paid to the state of California. So it allows for an indirect deduction for all of those state and local taxes, all of the California income taxes that get paid through the partnership, because again, of the reduction of those amounts going out to the partners. Now, it doesn't mean, remember, that the owners at the partners, their 1040 doesn't get an extra deduction. They just have a smaller amount of income because of the payment made to the FTB electively by the pass-through entity. So here's some quick examples. By the way, I want to give you a couple caveats here. For this analysis, I am using one flat rate as a federal rate, 37%. I'm using one flat rate for a California tax, 9.3%. That's obviously not the case. There are brackets that we run through. I'm really just using these numbers so that we can understand how the interplay of the elective tax creates essentially a deduction on a federal level. So that's what I'm walking through here. But the savings is very real as part of this. And I'll talk a little bit more about some of the limitations on this afterwards. But let's take an example of before this law was in place. Let's say that a partner owned an interest in a partnership or in an S corporation, and they had $500,000 of K1-able income to them. Now, before the bill, again, $500,000 of taxable income to the owner, that at a 9.3%, let's use for this example, a 9.3% tax rate. That's a $46,500 tax bill to the FTB. But remember, we had $500,000 going out from a federal level too, and the federal deduction is limited to $10,000. And because of that, even though we had to pay $46,500 to the FTB, we only got to bring the $500,000 taxable income down to $490,000. We were limited by the $10,000 deduction and that limitation. And a 37% rate on $490,000, 500 minus the $10,000 deduction, is $181,300. Combined, that's a tax of $227,800. After AB150, what happens? Well, we've got the same $500,000 of taxable income to one of the partners or the S Corp owner, the shareholder, same $46,500 owed to the FTB because we're still presuming the 9.3% tax rate. But now what's happened? The amount that's coming out of the partnership, getting K1'd out to the owner, is reduced by the 46.5. That's the indirect deduction. So if you look at these numbers, when you reduce it by 46.5, what you actually have is taxable income of $453,000 and change. And the tax on that at 37% is almost $168,000 for a total tax bill of just over $214,000. That's a total reduction of $13,505, or almost 3%. That's an almost 3% reduction on the effective tax rate, both that applies, combining federal and California rates. And there's one example I want to go through that makes this even clearer, because we talk about that $10,000 deduction that we all have for state and local taxes, but in fact, almost all of our clients have already used up that $10,000 deduction before we're even worried about the $500,000 coming out of a partnership. They've got real estate taxes they're paying or income somewhere else. So we're already using that $10,000 deduction somewhere else. They're essentially having to pay all of the federal taxes on this entire $500,000 and all of the California taxes on the entire $500,000, again, because the deduction is probably utilized somewhere else. That $10,000 deduction is utilized elsewhere. So what does that mean? Again, $500,000 of taxable income goes to the partner. We pay 46.5 to the FTB. Then we look at 37% on a full 500,000. That's a tax bill of $231,500. Excuse me, of 185,000. So you end up with a total tax bill of $231,500. The after tax, AB150, for the same reason we talked about before, is only $214,000 and change, which is a reduction of $17,000, more than $17,000, or 3.4%. And of course, those deductions, the higher the income gets from the pass-through entity, the more impactful this law can be. So it's really something that is surprising we're not hearing more about it, and it's amazing how impactful it can be for our clients. But let's talk about some of the issues that we need to think about. The bill itself says that, at least for 2021, the rules are different for the following year, but for 2021, the election doesn't even need to be made until the tax return is due. But we cannot wait for that, because if we're going to take that federal deduction, that tax needs to be paid in the taxable year 2021. So when I say we need to get in touch with our tax advisors, this is why I'm saying that, because we need to make sure that we're paying attention to exactly what we believe our tax liability will be this year, compare it to what it was last year, and do anything we can to take full advantage of this new law. It also contains an odd ownership restriction. I mentioned that there were some limitations, and this is the biggest limitation. A pass-through entity, a limited partnership or an S corporation, can take advantage of this if its partners are individuals, if its partners are corporations, if its partners are trusts and estates. All of those things can take advantage. But if a limited partnership has as one of its partners another limited partnership, doesn't qualify for this new law. It doesn't qualify for the indirect deduction. It's not entirely clear, to me at least, why that restriction is there, but it seems pretty clear in the language. Now, we may get something from the FTB explaining this or giving us some kind of workaround, but I wouldn't count on that. Instead, what we might see some clients thinking about, and I'm sorry, let me be clearer about what that means. So let's imagine we have a partnership. We have lots of clients who own real estate partnerships with other investors. So if you own an LLC owned by 4 different parties, it owns real estate. You own your piece individually. 3 others own it individually as well. But that 4th investor is made up of maybe 2 or 3 people, and they formed their own LLC to buy their 25% of this limited partnership. That alone will disqualify the entire pass-through from being able to take advantage of this. So what can we do? Well, maybe there's some restructuring that can be done. Maybe the reason that they initially bought those shares in that fashion is because that was the way they bought other partnerships as well. And this is sort of an operating LLC for them. Well, maybe it's worth everyone's time for them to decide to come out of that LLC and to take their interests in our LLC, our real estate investment LLC, take that in their own names personally rather than through their own LLC. It doesn't really make any difference to them. Perhaps there's some liability protection concerns they have, things like that. But from a tax perspective, it doesn't make much difference. And yet it qualifies us now for this pass-through, for this indirect deduction. So you want to pay attention to that. And those are some things we want to think about. And it's just another example of why we need to get in touch with tax advisors as soon as possible. And to the extent you have questions, please reach out to us. Okay, a couple other caveats that I want to mention. First of all, as I said before, the elective tax payment is 9.3%, and it's fixed there, and it's non-refundable. So one point is, for those taxpayers who are making a significant amount of income, they pay more than 9.3% in California income taxes. They're only going to get the benefit of this indirect deduction up to 9.3%. The remaining delta to take them up to 13 point whatever California income taxes, unfortunately, that deduction will not be available. But there's still a very large savings for those individuals as well. They still get to deduct most of most of the California taxes that they're liable for through the income coming out of the partnership. It's also true that for those partners in this partnership who make less than a certain amount, they may not be in the 9.3% bracket either. And in that situation, they're giving up a little too much in California taxes. And that amount you gave up is not a credit that you can get a refund on. But it does allow for a carry forward. So it doesn't mean we'd lose it. It just means we're going to have to carry it forward in future years to pay off some of the California taxes that will come due in 2022 and afterwards. The other real question that comes up a lot, I mean, there are a lot of questions about this, and there are a lot of ambiguities, and so I'm not trying to cover everything about this, and we're going to see a lot more soon. And again, we'll be back in front of you to talk about those things as we get clarity. But one of the issues is with what are called guaranteed payments. Many of you know that if you take what is equivalent essentially to a salary out of a limited partnership, you don't get a W-2 for that salary. It's a guaranteed payment that comes out essentially first before distributions of profits out of the FLP, or excuse me, out of the limited partnership. Before those distributions of profit come out, those guaranteed payments come out, and they act like salary to those partners who are working for the partnership. It's not clear how this rule interacts with guaranteed payments. Certainly, I would hope that we get some clarity that it works exactly like it does for distributions of profits. We just don't know that yet. So while we do want to be doing some planning, there are some things we want to be thinking through. There are some things we still just don't know. I also want to come back to something I forgot to mention before. When I said a partnership can't be owned by another partnership to qualify, that's true. I didn't mention S corporations, and that's because, as many of you know, S corporations cannot be owned by partnerships. That blows the S election, so that's why I didn't even get into that. So that restriction is really only applicable to limited partnerships. So, excuse me, if I haven't made this clear enough, this is critical that you get in touch with your tax advisors, talk to your CPA and other advisors, call us to the extent you have questions. This is really, really good news for a lot of business owners. It's thrilling that the IRS is going to permit this. There were a lot of thoughts about ways to allow us to get indirect deductions. There were even some concepts about maybe we can create contributions to the government that we get a charitable deduction for. The IRS squashed all of that very quickly, but this they are allowing. Again, we may need to look at some of the business models to make sure we qualify in the most effective way. And we know we've got some ambiguities. We're going to have to take a little bit of time. We're going to have to look through the structures that we have. Again, I think that partnership, that tiered partnership issue is going to rear its ugly head for many of our clients. And so we may have to think through how we can change what we're doing to allow those partners to take advantage of it. And then again, how many times can I say it? Make sure you're talking to your CPAs. Wanted to make sure you see the last disclosure slide. As you think about this, as you read more about it, there'll be more coming from us, and there'll be more coming that you will see, I'm certain, because of the amount of savings and the amount of people to whom this applies. But in the meantime, please reach out to us. Please reach out to your advisors, and we look forward to helping you with this. Thank you very much.